Hey everybody, welcome back to Trades and Gains. I'm your host. Oh my God. Hey everybody, welcome back to Trades and Gains. I'm your host Max Pitts, and degenerates, doom scrollers, and again, you closet perma bears. Today is March 30th of 2025, and if you thought last week was bad, buckle up because the Dow dropped 2% last week. The Nasdaq lost 3.9%, and the S&P 500 is down 2.97%. And that's just the appetizer before we have Trump's Liberation Day tariffs hit on April 2nd. Sticky inflation, collapsing consumer sentiment, and broad market outflows. This isn't volatility, it's a controlled demolition. Let's go ahead and break down what happened last week in the markets. So, to kick things off, we have Trump's Liberation Day coming up next week. He's expected to drop reciprocal tariffs on Wednesday, and Wall Street might not be ready for what's coming. The consensus here is a minus 9% tariff expected. Goldman Sachs says this could be closer to 18%, however, because they think it could be double what the market and retailers are expecting. And admin officials hint this is just a starting point for negotiations. So mind you, it could be double, but it could even go up higher from this point as well. So expect volatility in autos and semis like Tesla, GM, Ford, Apple, and NVDA. And tech-heavy indexes like QQQ could get a slap in the mouth all over again if tariffs shock to the upside in this move. Again, this is something that markets are not going to be able to dismiss. Canada, the EU, and China are expected to retaliate as well, and that's where a lot of this volatility could come from. Expect closer to 20%, not 9%, to be honest. The last quarter PCE print clocked in hot at 0.4% month over month against 0.3% expected, and 2.8% year over year. And mind you, our year over year number needs to be at 2%. So combine that with a surprise plunge in consumer spending and sentiment, which if you've been following any of the consumer sentiment reports, you'll see discretionary spending is down, and people are really just holding on to their cash at the end of the day because they can't afford the quality of life that their city is providing them based on their income and inflation. So that's really not a shock that PCE came in hot, because we have to understand that if you look at all the reports that kind of make that up, from the Michigan Consumer Report, CPI, PCE, all these other different acronyms, if those are coming in consistently under or over, then you can expect that the things that will influence something like our PCE print would not be a shock. On stream, I told everyone that PCE was probably going to come in hot just because consumer spending's down, and our year-over-year number was going to come in hot just because those numbers that would cause us to have a drawdown have just not been hitting in general. Now, the University of Michigan sentiment dropped to 57, as we mentioned last week, and that has been the lowest level since November of 2022. So is it really a shock that PCE came in hotter than expected? And GDP now from the Atlanta Fed sees Q1 growth falling minus 2.8%. And that's not a slowdown. That's the market stalling in midair. That's like the airplane's engines shutting off mid-flight while you're 20,000 feet in the air, people. Now, let's go ahead and talk about some of our options flow from last week as well, from our favorite data provider, Investor Central Club. So going ahead and diving into this right away, we had SPY lead overall flow like we do every week. And with that, we had 281 million in overall flow, with only 68 million in calls against 213 million in total puts. Our most common contract here was the April 17th 560 puts, where we saw a lot of money flow into these boys. You got to think, these are near the money and they're urgent. So you gotta like put two and two together sometimes. If we see a lot of near the money and urgent, that means that our big guys are expecting more downside and are hedging against their current positions. QQQ, we saw 129 million in flow. Well, no, first things first. NVIDIA, that is just turning into a casino at this point. We had 136 million in total flow with 75 million in calls against 60 million in puts. Again, this could be hedging, this could be institutional rotations, but again, with tariffs coming down the pipeline, that sentiment could quickly flip on Monday. QQQ, we had 129 million in flow with 58 million in calls against 71 million in total puts. We had 7 big trades here in QQQ, so let's go ahead and take a look at that. Our most common contract for QQQ were the April 17th 475 strikes as our most frequent. And the NASDAQ is still the blast radius for tech. So that could take a serious beating opening up markets on Monday. But who knows, we could be smoking opium and we could see everything flip green as well. NVIDIA, again, we already went over that. Tesla, we had 114 million in total flow with 59 million in calls against 55 million in puts. NVIDIA and Tesla are really just like, you got to pick one side and stick with it because the flow is usually 40-60, 45-55, 50-50. Our most common contract with that Tesla, though, were the $300 strikes expected on April 4th of 2025. So that would be for this week as well. So it looks like we have some people aggressively hedging on the upside for Tesla here. IWM, we had 90 million in total flow, mostly bearish here. Again, if you follow printing tendies, you'll know that his disdain for IWM is very real and within good reason. Our most common contract within that IWM flow sentiment was 18 hits for the April 17th, 2025 191. So we're expecting a lot more downside in IWM, especially from those institutions. We have a couple golden tickers flashing here as well. Names like FSLR, AVGO, PLTR, Meta, and Mister showed elevated downside positioning, with Broadcom and Palantir had sizable June put buys indicating bigger picture worry for those sectors, really. And here's another bonus red flag. Carvana had a massive $6.4 million call buy for the $90 strike expiring on 4/19. Either someone knows something or someone's yellowing with size here. Now, some dark pools, they are looking to dump everything, folks. SPY saw over $1.5 billion in dark pool prints here. Let's go ahead and reformat this so it brings up the most. The biggest came at 558.76 and 555.94, both below the spot, and that's quite the distribution of money. So it looks like people are expecting a lot more downside with institutions putting essentially buy orders in below what the spot of SPY is today. QQQ, we had $420 million in prints just before the close, confirming the put flow narrative that we just saw. So this means institutions are offloading shares, probably rotating into something else, and that is why we saw so many QQQ puts. NVIDIA had 533 million in blocks at the $880 level. That's not retail, that's smart money walking out the side door. And we had LQD, HYG, and TLT all seeing size come in, and bonds are getting that love again, which if you have ever followed this channel, anytime we see bonds rise, stocks fall. For some reason, bonds and gold, the two safe havens people will flock to. And MU and XLF also had mega blocks. MU had 373 million dollar print ahead of its earnings call, and XLF's print signal that financials aren't immune to any type of downside this time. Now, some quick hits here. We had Tesla, which was down 3% again. Where Amazon and Meta are down 3 to 4%. Consumers are broke, and tech is actually absolutely exhausted at this point. Lulu cratered 14% on weak guidance, plus tariff margin pain. Retail ain't so resilient anymore. Looks like Walmart's about to become everybody's favorite. Walla 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 world. I don't know if y'all remember that. The CoreWeave IPO tanked below $40 within minutes. IPO buyers got absolute. It was like a meme coin rug, damn near. They got completely the carpet taken out from under them, falling on their ass, whatever you want to call it. NVIDIA backed or not, AI hype just is not enough anymore. You gotta start literally pulling a unicorn out of your ass if you want to impress these people. And gold cleared $3,100 and is still rising. In case you needed more proof, this is a full-on risk-off environment. We also have our jobs report on Friday. The March jobs report is coming in hot Friday. It might decide if a soft landing hope stays alive. We're expecting plus 135,000 jobs added against 151,000 from the month before, and unemployment is expected to remain steady around 4.1%, with wage growth being up 0.3% month over month and 3.9% over year. I think we don't hit the wage growth in 0.3%. I think that's going to come under, which is not going to be good, or it's going to come in hot with the estimate of jobs added coming under as well, showing that maybe there's a little more emphasis on executive leadership versus the average worker. So obviously wage growth would go up while jobs would go down, meaning that people are paying higher wages, but it's for more senior positions. We have earnings guidance that is already turning ugly. 68 S&P 500 companies have issued negative Q1 guidance so far. That's above the 5-year average, which is 57, and above the 10-year average, which is at 62. And Wall Street entered 2025 a little too optimistic, it looks like. And companies are now walking those expectations back before earnings seasons even kick off on April 11th. If you remember, we broke a story about how T-Mobile kind of went under on guidance, and that was a retail stock. So that should have given you some kind of indication that this was headed down our way. Now, what's coming this week? We have Monday PMI, Dallas Fed manufacturing minor data, and market is still digesting here. We have on Tuesday, JOLTS, ISM manufacturing, and PMI final prints. Labor demand is going to get tested that day. Wednesday, we have Trump's Liberation Day, reciprocal tariffs incoming. Expect a lot of volatility on that day. Thursday, we have Challenger layoffs, jobless claims, ISM services, which is just going to add more fuel for the labor debate. And for Friday, the big one, March jobs report, 135K jobs expected as mentioned, and unemployment is expected to stay at 4.1%. A weak print means stagflation fears are going to spike, like I just kind of broke down for you. If this comes in hot, the Fed stays frozen. If it misses, stagflation fears go to DEFCON 1, orange, red, orange level, whatever your panic level is, that is what we're heading towards. Now, markets are pricing in more than tariffs. They're pricing in uncertainty, policy failure, and inflation fatigue. Options traders are bracing for more pain, dark pools are disturbing, and the economic calendar is packed with tripwires. So watch out for that. This isn't just noise, this is the beginning of a narrative shift. Hit that like button if you enjoy pain, subscribe if you're enjoying chaos, and let me know in the comments if you're buying the dip or shorting everything into the ground. Stay hedged, stay cynical, and I'll catch you tomorrow for our daily market recap. I hope you enjoyed this weekly outlook report. I love you all. Let's have a great week this week. Let's hit some 1,000% plays. I'll be following ITM Banks on SPY. I'll be following Milky Filky for IWM. So I'll be playing both of those tickers this week. Anyways, see you guys in the next one. Love you all, and bye.